You have so much under management. If you look at your assets, 592 billion, the world's oldest sovereign wealth fund. So where do you see the main opportunities? I know you're interested in infrastructure, especially in the UK. Is that where you want to increase spending this year?
If I want to compare our returns last 10 years, I don't think we could repeat the same returns for the coming 10 years. That's why we want to do something different. That's why we are expanding in the infrastructure and the credit. I think we have to take more risk in order to maintain the returns. So that's why 3 years ago we started to invest in infrastructure in UK, Spain, Australia. So far we invested around $3 billion in different sectors of the infrastructure and power distribution, airports, seaports. So this is the portfolio of our infrastructure.
But right now, it's awfully difficult to find alpha.
Definitely.
You're clearly looking for it in infrastructure.
I totally agree.
You're looking for it in infrastructure. You're looking for it in credit. Where are you getting it today? Who's delivering outperformance in what strategies and in what asset classes? Let
me tell you what we are trying to do in the last 3 to 4 years. Where's alpha? It's in the private. It's in the credit. If you look to the S&P returns the last 10 years compared to the risk related, you have to take more risk in order to make less returns, especially in the public market. So we have no choice, only to take more risk in order to maintain returns.
But does the election of Donald Trump actually change the appetite for infrastructure? If you're trying to reflate the US by spending more, does it also force other countries around the world to do the same? This is something central banks have been asking for quite some time.
Yeah, the stimulus is yet to be seen. I mean, this is what has been taught. This is the talks has been during the campaign, but this is yet to be seen. This is would not happen tomorrow. It needs a change in the legislation. So this will take probably longer.
Is the potential for policy change and maybe more economic growth to come with it enough to inspire or prompt you to allocate more geographically toward the U.S.?
If I look to the global economy, I would say the U.S. probably is ahead of everyone in terms of growth. It's because, and also the positive attitude after the election, especially in the tax cuts, stimulus, deregulation. This is probably will probably enhance the growth. Also, what we have seen is that finally the physicals start to work. It used to be only the monetary policy. Now we have seen what we have seen is the physicals start to work. So this is probably the positive side of the U.S. in particular and in the global economy.
Are you, as a result, taking money out of emerging markets, out of Europe, for example, and reallocating it to the U.S.?
Not really. We still maintain the highest allocation to the U.S.
Okay, how much will you add to that allocation? And in what, how do you invest in the U.S. right now? Are you going after companies?
We are mainly in the public market and in the private. We start to, in the last 3 years, we start to look into the West Coast, going to expand especially in the venture and the private small starters company. If what we are looking to write a big check for long-term investors, you need to see that projects in the infrastructure. Otherwise, there is no size. I mean, you need a scale.
But what about public companies? Are there any public companies that look attractive because of what you were mentioning, deregulation and the Trump effect? We haven't looked at anything specific these days.
You have traditionally looked to long-only active equity managers as a potential source of alpha. Given how much trouble those long-only active equity managers have had beating the benchmark, is there any point doing that any longer? If you're investing in U.S. public equities, are you better off just going into a passive vehicle?
You are absolutely right. What we are trying, I mean, why do I have to pay extra fees for less returns? So I would rather to be in the passive and shift to the private.
Are you all passive now in U.S. equities?
Not all. We still have an active management. We still have an active management.
Are you headed toward 100% passive?
No.
No. So
Not-
you'll always have some exposure to active equities.
Yes.
Sir, I want to ask you about Dow Chemical. So you hold preferred equity in Dow Chemical.
Yeah.
What are the plans of converting them into common equity?
I think we will hold for the common equity right now. I think the company will still has a positive sign
To convert
grow.
it, what, this year, in the next couple of quarters?
So far it has been converted into common equity, so we will hold to that position.
Will you increase your position on that?
I'm not sure.
How will you decide it?
I think there is a positive sign in the petrochemical industries, and with the oil prices, I think the company will probably do well.
And so on the back of that, if it will do well, when do you expect to make a decision on whether to increase your exposure to Dow?
I don't think we'll increase at the current level.
Okay.
Since you brought up fees, let's talk a little bit more about fees. What, from your perspective, is acceptable when it comes to long-only active equity? How much are you prepared to pay in basis points? And similarly, in private equity, what's acceptable?
We shoot for the lowest.
Of course.
I mean, this is where we save. This is where we save money and I would say outperform the index. But it's a negotiation.
How much luck are you having? Everybody wants to negotiate with the general partner. That's what every limited partner should want to chisel the GP on fees. But are you having any success?
That's why 5 years ago we started to buy in the GPs. So we want to share that carry.
That's your hedge.
That's our hedge.
Mr. Al-Badr, talk to me a little bit about technology. So I know you've been invested, for example, in Jawbone. There have been many rivals to Jawbone, but what is your interest in similar companies right now, or in technology companies?
As I mentioned, we start to look into the private. So 3 years ago, we established a $2 billion portfolio to invest in the venture capital companies. Not in Series A, B, but probably D, E, after it stabilizes, after it has a cash flow, positive cash flow. We have probably now in our portfolio, we have 8, 9 companies.
Mm-hmm.
Are you doing this directly, or are you doing it? So how much more is direct investing becoming a part of what you do?
It's still small.
What percentage of assets are direct right now?
It's less than, probably it's around 1 to 2%. It's still small.
Where would you like it to be?
Probably between 7 and 8.
That's a lot. Many billions of dollars you're going to bring in-house.
You know, if I look to the S&P, the expected returns for the coming 10 years is 4%, vis-a-vis volatility of 17, 18%. 10 years ago, it was 7 to 8 and 12 to 14. I have no choice only to go to more of a private. I have no choice. The alpha is there.
But the private means that the risk, and you said this very clearly, the risk is so much bigger, right? So how do you help, if you're invested in a private company, do you then support them and help them grow by influencing where they should be?
Still, 7 to 8% is a big lump sum, but it's small compared to the core,
overall,
to the core portfolio.
Mr. Al-Badr, do you expect a lot more volatility this year on the markets?
Oh, for sure.
How much? Worse than 2016?
I think it's going to be more than
more volatility.
More volatility. I think so. You know, there is elections coming in. Election in Europe, a new president in the U.S. So yet to be seen.
Before we finish, I'd love to ask you about a controversial topic: hedge funds. What are you doing about hedge funds these days?
We have a small portfolio of hedge funds. I don't think we will increase the hedge fund. I don't think we will increase the hedge funds allocation into our alternative investment. Probably would go to rather asset class rather than the hedge funds.
More to private equity, more to real estate, more to infrastructure?
Yes.
Because they offer better risk-adjusted returns?
No, because I don't think there is a big alpha in the hedge funds.
The golden age of the hedge fund is over?
This is my personal opinion. I don't want to be offensive against anyone.
Oh, it's in Davos. We can afford to be. Mr. Al-Saad, just one final question. Do you believe that anti-globalization will be tested, or globalization will be tested in 2017 through trade wars?
My biggest fear is protectionism. If the U.S. imposes taxes with Mexico or Canada, this is the biggest trade partners. This is where a war everyone will lose. This is my biggest threat.